we're going to be talking about real estate. We're talking about single family home REIT run by the Peak Group. And I have two people here with me to talk about that. I have, you can see in the center is Ryan Bowers. He is the president and CEO of the Peak Group. He oversees the fund management, the investment analysis, acquisitions, asset management, etc. He has experience as an investor personally, a great deal of single family home experience, and really believes in real estate as the key to building and sustaining long-term wealth. I grew up in Oregon, attended Whitworth University, where he studied business management, and has been an entrepreneur since. My other guest is Joe Ollis. He is the chairman of the board and the chief investment officer of the Peak Group. Joe's expertise is in portfolio construction, risk management, underwriting, valuation, due diligence. He has experience running funds in the past, and so it's really a great synergy between the two of them to put their two expertises together to come together to make the Peak REIT that we're going to be talking about tonight. But with that introduction, let me turn some time over to Joe, and he's going to, or not to Joe, to Ryan first, and he's going to talk a little bit more about this. Let me pull our other mugs off of here, and we'll give him some time to talk.
Jim, thanks so much. I've been looking forward to this for some time. We've been on your platform now for a little over 30 days, and we've been quite frankly overwhelmed with kind of the outpouring from this group. It's been incredible to get to hear from a lot of you. I know our investment team has been speaking incredibly highly of everything that's been going on. So we're excited to be here tonight to go more in depth from kind of our lips on who we are, what we've done, and where we're going, and why we think that not only single family rentals is a great investment, but hopefully you see that the Peak Housing REIT is a good investment for you as well. So just going to kind of jump in here to both who we are as the Peak Group, and then where the REIT is currently today, and then we will get into where it's going. And so to first kind of explain our background and who we are. We've been in single family rentals for the past 20 years. My brother and I started in Oregon, where we're from, got a quick passion for it, knew we needed to get to another part of the country to really build something. And that's why we ended up in the Dallas-Fort Worth market. And so it's gone from there. And so really over the past decade, we have really worked hard on building our vertical integration of all of our operating companies. And so on the left side of the screen, you'll see this funnel. And so the simplicity of it is we kind of have two jobs. Our job is to acquire homes. And then at the bottom of that funnel is to kick out profits for our shareholders. But the middle of that stack, there's a whole lot of things that have to happen. And that's what we have created with the foundation of our vertical integration of all of our operating companies, where we have the brokerage for acquisitions and the title agency to make sure we're getting things closed on time and quickly, and our construction company, our maintenance company, and then ultimately our property management company and asset management arm as well. And so all of those things allow us to really put a firm grasp on what it is we're controlling, which allows us to keep costs down. It allows us to control the directions that we're going and hopefully kick out the greatest profit to all of our shareholders as we can. And then on the REIT side here, on the right side of this screen that you'll see, is we launched the REIT in Q1 of 2020. So end of March is when we launched it. And since then, we've acquired over 1,500 what we considered scattered site homes. So these would be, existing homes all over the place, scattered throughout the markets that we're in. We've raised over $100 million of equity, primarily through high net worth investors like yourselves. We have over 450 investors now in that group. Our valuation of those existing homes is $210 million. Plus, we've already pre-funded right at $100 million of build for rent communities with that equity as well that will be delivered over these next couple of years. And we'll get into that a bit here later as well, so you can see that. And so a couple of things that we're really excited about that we've already accomplished is, number one, we're already kicking out quarterly distributions. And so, when you start anything from scratch, there's a lot of overhead. Of course, when you're acquiring these portfolios and these assets, there's a lot of expenses to onboard them. We've been able to overcome all those expenses and already turn a profit. 2% maybe not doesn't sound like a huge distribution on an annual basis, but to be this early in the game doing it, we think it's a great achievement, and that will continue to climb. And our share price has already gone from $10 a share to the current $12.16 a share. And so we've already been able to show our skill set in how we acquire, manage, and turn profits. And we think that that will continue as we go. And so moving on to the next one, I'm not going to spend a whole lot of time here simply because you can see this on our portal and our websites. But just to kind of give you a grasp of the last 20 years, again, you see the picture here. My brother Todd is in this with me, who's been my partner since day one. Todd does a great job running all things construction and maintenance. So I like to say if it has to do with a hammer, he's your guy, not me. And so the first house that you see in that timeline, bottom left, is our first house in Springfield, Oregon. And that's where we started. And that's where kind of the passion for single family rentals began. And we've been fortunate as you come through that. We got to Texas in 2008, and then 2011 is when we really started rolling out the vertical stack of all of our operating companies. And we're fortunate enough to not only be in an asset class that we love, but then to have that asset class turn into an institutional asset class that we have today, which has allowed us to have the Peak Housing REIT. And we think that we are in the beginning stages of an industry that's going to have a huge amount of runway over these next 10 to 15 years. And we're in a great position to be able to capitalize on that. By 2016, we had rebranded everything to the Peak Group, which allowed us then to extend that branding into the Peak Housing REIT that we did in 2020. And so one of the things I didn't mention up front is our team. So we have currently 89 team members that represent the Peak Group. And this group that you see here is our executive team for the Peak Housing REIT. And these 7 individuals that serve with me are amazing. These folks have a tremendous amount of talent, but more importantly, they have a tremendous amount of passion for what we're doing. And behind this group is the rest of those 89 folks that show up every day and work really hard to accomplish what it is we do to be able to kick these things out. And so it's an amazing team that pushes this ball forward and allows us to accomplish a whole lot of things. The next slide here is what I'll first say is any pictures you see of homes here are our homes. These are homes owned by the REIT. When you log into our investor portal, there's a link in there that you can go in, and on the map, you can look at any of our homes. So you can pull up any pictures that we have, Zillow. We want you to see the homes and the assets that we own because it's something that we're proud of, and you can get a really good grasp of what we're doing. And so historically, we own single family rentals for the benefits of cash flow, obviously the tax efficiency for depreciation. We expect asset appreciation over time, and then the downside mitigation of risk of owning rental income and assets in down markets. The advantage now of this all becoming an institutional asset class is that you get far greater diversification in owning a piece of a far bigger portfolio. We can drop OPEXs in a lot of ways because of our efficiencies in size, our efficiencies in management, maintenance, vendor relationships, asset management, things like lending, institutionalization of large portfolios has allowed us to push a lot of our costs down. And so most importantly, you truly get to be passive with this being an institutional asset class instead of managing these portfolios. So we think that we're able to deliver a higher return and also make it to where you don't have to manage the properties, which is a great thing. So how do we grow the REIT? We have 3 main buckets of how we grow our assets in the REIT. And so the first big bucket that we have is our wholesale acquisitions. And so when you think about wholesale acquisitions, think about a value add play. How do we add value to this? And this could be a single home acquisition that we went out and acquired. We're going to fix up, put a resident in there and rent it out. Could be a large portfolio. And we're going to show you a couple large portfolios that we've acquired this year that had a lot of value add components to it that allow us to bring in kind of into that wholesale acquisition bucket. The second one is our build for rent communities. And so if you've done any research lately on single family rentals, you have stumbled across all of the rave of build for rent communities. And so now what we're seeing is, instead of going out and building infill homes that we turn into rentals, we're building whole developments now, where instead of selling these off to owner occupants, we're literally building all of these and renting them out as a community. And those have great demand. We do JV partnerships with, and this says PHR on there, which is the Peak Housing REIT. So this allows us to partner with institutional capital to make our investment inside the REIT go further and maximize our return dollars back to our investors. We'll get into the new markets in a bit on how we get into markets, how we look at them, but we run what we like to call our hub and spoke strategy. And so where we are a little bit unique is we like to have the hub with our primary and our secondary markets, and then spoke those out to tertiary markets, smaller markets that allow us to have other advantages in those. And so Dallas-Fort Worth is obviously a primary market. Markets like Lubbock, Texarkana, and Corpus Christi would be our spokes off of those hubs. And then a secondary hub would be something like Indianapolis that we are in currently as well. And then our third bucket, our last bucket, is what we like to refer to as one of our secret sauces, and that is the UPREIT 721 exchange bucket. And so of the roughly 15 million single family rentals in the market today, the majority of those are owned by the baby boomers who are ready to be done. So we all know what a 1031 exchange is, but not a lot of people know what a 721 exchange is. And they function very much the same way, but instead of having to sell my assets and go roll them into new assets, we can roll portfolios of existing rental properties into the operating partnership in the REIT and exchange out the equity for shares in the REIT. And so those owners now truly get to become passive, have all the rewards of those shares, just like they were owning those properties as well. They get to control the tax capital gains on how they sell those shares or liquidate or pass them on to their estate and take the benefits from that standpoint. So our markets, I won't hit on this too much as a whole, but we're currently in 3 states, Texas, Missouri, and Indiana. And so we will continue to grow mainly through the South and the Sun Belt as we process through this. You'll see some major numbers here. Our average cost is $140,000 per unit, and our current average rent's $1,135 a month. And so we'll dive into what we focus on being really the workforce affordable housing at a high quality level. And so a lot of people will look at that average and go, wow, you know, what kind of stuff are you buying? Is this lower end stuff? And so we're going to run through a few scenarios here to show you we are very, very focused on high quality homes. And so Texarkana here, this was our first large portfolio that we acquired. This was 394 units from a baby boomer who was just ready to be done. We were able to acquire this at about $90,000 per unit. You can see up top, average rent is $837 a month, but the market rent there is $933 a month on average on our portfolio. So we have a lot of juice left in this portfolio to really continue to increase the valuation of what it is we're doing there. The second portfolio is one that we just acquired here in August, and this is in Springfield, Missouri. This was 290 home package, and these are beautiful. Again, baby boomer, ready to be done, ready to retire. This was actually a builder slash developer, and of the 290 homes, 250 of them were built between 2004 and 2012. You can see that our rents are low here. And so this is an amazing package that we feel has incredible upside over time. And so now as we move into the build for rent space, this is just Dallas-Fort Worth. In fact, you can see Fort Worth in the middle of the screen there. And so you can kind of see the spread of what we have across kind of the Fort Worth, Tarrant County side of the Metroplex. This represents almost 750 homes. All of these are in process. So the Woods, which is in the middle of your screen, is completed and performing extremely well. Upper right-hand corner is Parkside, which you're going to see a picture of next year. Will be finished here the first quarter of this next year, all the way over to the Bluffs to your left, which is finishing up entitlements, and then we'll go into the development phase, would be the last one that's kind of furthest behind there. So a lot of exciting things to happen there. But when you look at the Parkside homes, this is what you're looking at. And so what happens is when we look at that $140,000 total average, these homes on average we're all into for right at $270,000 per home. There's 23 of these, but the valuation on each one of these is between $400,000 and $450,000 if we were to have taken them and sold them to owner occupants. And so it's one of those advantages of that vertical integration stack of having our own construction company and our ability to develop, where we can bring tremendous value for our REIT and our investors through this. And so these are all things that we're very excited for, whether it's acquisitions of the portfolios that we've got room to move up or the new builds. And so this next one, when we get into how do we look at markets? And so we talked about the hub and the spokes already, but let's look at a couple main points. So the top kind of paragraph here, I want you to focus on a couple of things. Number one is, in the affordable housing side that we operate, we always want to make sure that our rents are no more than 30% of the total household income. So if we can stay at or below that 30% level of household income, a very stable place for our residents to operate. So if we have a recession, we're in that range, our occupancy should stay high, and we're strong. And that's an area we want to really focus on. We also look at making sure things like our areas are growing, that we have at least 1% annual growth on our population in the markets that we're going into. And then diversification of jobs. We want strong jobs, diversified out through multiple areas so that our residents have places to work. And so you'll see on the right side of the screen is Lubbock, Texas. And so most people would think, wow, Lubbock, Texas, huh? Why would we want to go there? But when you break down it just from a factual standpoint, it's a great market. 320,000 people. It grew by over 11% in the last decade. GDP was up by 50%. Diversification of jobs. The niche market rating for this is an A. So when we break this thing down, and then when you go look at it and you just see the growth that's happening in a market like Lubbock, you see why we're buying in Lubbock. We'll have over 200 homes in Lubbock closed by the end of this year. And we're excited about this market and other markets like it. And so at the bottom, you'll just see kind of the makeup of the portfolio. Again, we already talked about 140,000 per unit. Right now, we believe we're under market by about 16% just because of so many of these portfolios that we bought are low, and that's our value add play. And so we have a current cap in place of about 5.68, but we're going to go well over 7% by the time we can just make up that 16%. And we know by the time that we do that, with the way the inflation is hitting the market right now, that our rents will be even that much higher. So last thing I want to touch on is, how are we growing? So you've seen what we've done. You see how we're filling these 3 buckets of homes. Where are we going? And so this chart we just show through 2025. Our objective is to be at 10,000 homes or more. And you'll see in the dark green along the bottom that this year was about 1,500 homes. We'll go to about 2,000 next year, and it'll stay steady along that path. But as long as we do that, it keeps pushing us up to hit those goals that we have. And then on the right, you can see those primary markets that we're focused on that we talked about earlier. We have several markets within those states that we're focused on in getting to. And so I'm going to pass it over to Joe, and he's going to go into why single family housing is so good, and hopefully why you would want to make an investment into the Peak Housing REIT. So Joe, take it away.
Yeah, thank you very much. And I think he's going to be changing over to my picture here in a second. So first off, it's great to talk to everybody here today with the White Coat Investors team, and we're excited to share both information about our REIT, but also more importantly, why you as an investor should be adding exposure to single family rental homes right now. I truly believe that there's never been a better time to be an investor in single family rentals. And I'm going to capture that a little bit today in these first few slides. And then I'm going to walk through our REIT investment specifically. So the first thing I want you to kind of capture is how big is this market? Because I think a lot of people don't realize this. A lot of people are very familiar with multifamily apartment complexes. You think about those podium style apartment complexes you might see in urban cores, or the very like garden style that you'll see out in the suburbs. That market cap, if you were to add up all those, is around $3.5 trillion. And interestingly enough, single family rentals, when you add up each of those individual little houses, it's right nearly there, the same size. So we're talking about a very large asset class here. And what's also kind of equally interesting is to see the adoption of single family rental markets and single family rentals over the last 10 years. So we've seen nearly a 30% growth over the last 20 years, but a lot of that has been accelerated and pulled forward over the last 10 years. And one of the key things is it comes down to the tenant's preference. People are choosing to be renters right now, and they're doing that because of the flexibility. A lot of people want this flexibility. They don't want the pain of being a homeowner or the financial responsibilities of the home ownership. They want to have somebody really make it easy for them. And I really look at, like in the past, I believe this is an early trend, and we're going to see this trend accelerate over the next 10 to 15 years. And I compare it to what happened with the automotive, with cars. If you go back 20 years, nobody leased their cars. You fast forward to today, nearly everybody leases their cars. And it's about the flexibility. It's about having something new and clean and not having to worry about a car after 3 years. It's about having the best safety and things like that. The same thing is happening in home ownership. And at the same time that we're talking about more and more people choosing to be renters, we also have a very significant demand and supply side equation that is going to very strongly favor continued housing price inflation and also rental inflation. And so I like to call this the demand side meets the supply side. And I want to capture and talk about each of these a little bit. On the demand side, you have the millennial generation, which is the largest generation in the US history, exiting their 20s, where they were the primary driver of the multifamily. So think back to those apartment complexes, to their peak, what's called household formation years. Household formation might be, a couple starting a family. It might be somebody wanting to have more space. It might be somebody who is splitting from a roommate. But regardless, we have this millennial side, which is the largest generation coming on the demand side. And what we're seeing is that they're choosing to rent single family rental houses. And why is that? It's because they want the more space. They want a backyard for their dog. They want an extra room for a home office or for their children. They want a garage where they can put all their toys. That demand side is coming online right now for the single family rental house, while on the supply side, we've had 10 years of severe constraints for the housing being delivered. And this graph right here kind of shows two things that I think is really important. The first is going clear back to 2010 at the tail end of the Great Recession. The home builders just got blown out. They disappeared. And when they started building again, they were building towards the highest margin homes. And what that meant is they weren't building the entry-level single-family rental style house. They were building the higher-end luxury, where they had the greatest margin. That led to severe constraints. And so you fast forward to 10 years of not building enough houses, and we have a substantial supply-demand imbalance. And that was further set on fire, really, because of COVID. And so COVID accelerated two trends. The first is people wanted more space. They were choosing to leave the urban, denser apartment complexes in favor of being a renter for a single-family rental home. And I already captured a little bit of that. But at the same time, COVID also hit the supply side. Builders stopped building while we were shut down. As we ramped back up, we had supply shortages and labor shortages, and all that led to another year of under-delivery of units. And so what does that all mean? And we can see like the price growth meeting the demand here on this side, but that also led to significantly higher rents. One of the most common questions I get is what's going to happen in an inflationary environment? And I think we're already seeing early indications of that today, where our core inflation measurements are now going from 2.5% to about 4.5%. And I think next year they're still projecting around 4.5%. But look at what the largest single family rental owners, which are publicly traded REITs today, once called Invitation Homes, in their latest report, we saw an 18.5% year-over-year rent growth. And that is entirely attributed to that supply-demand equation being met with inflationary pressures. And one thing I want investors to really understand is with single-family rental houses, just like apartment complexes, you set your lease rates yearly. So you rent to somebody for 1 year. That's a better equation when you're in an inflationary environment than if you were signing 10-year leases like you do at an industrial warehouse or 5-year leases in retail and office. And finally, if you put all this supply and demand and the acceleration due to COVID, there's one other tailwind that is coming to the single family marketplace. And that's something Ryan mentioned briefly, and that is the institutionalization of this asset class. So if you back up 20 years, 30 years for apartment complexes were primarily owned by smaller investors. And institutions in the early 80s only owned a fraction of the big apartment complexes you see. Fast forward to today in 2020, 2021, apartment complexes are 90% owned by institutions. We believe that same path is going to be followed by portfolios of single-family rental homes. And so today, single-family rental homes, only 3% of them are owned by institutional investors. And we're talking just the actual rentals today. A vast majority are owned by smaller investors. Now, what has happened in the last 10 years that's going to accelerate this trend? Well, a couple of things. The first is the advent of new technologies that enable us as operators to operate these portfolios of homes more efficiently. And we have countless examples that we can share about that. But the net result is it allows institutions to look at a portfolio of rental homes and use the same economics that they use applied to multifamily homes. That's allowing them now to come and write checks to invest in this marketplace. And we expect that we're very much just on the very early stages of this. And that should drive a big sense of urgency for our investors right now to get in as an investor with us. So I captured all these things, but I want you to really take away there's a supply-demand imbalance that's leading to inflationary pressure, which means higher rental rates. And at the same time, you have institutional money coming into this marketplace, and you have the opportunity as an investor today to enjoy a REIT at the very early stages. So with that, I'm going to kind of transition a little bit out of that and talk more about the Peak Housing REIT itself. So with the Peak Housing REIT, we have an evergreen fund structure. What that means is that we want to have our REIT around for the long term. There's a $25,000 minimum, and we can take investors who are investing through IRAs individually or through LLCs. We pay our dividends out quarterly, and investors are allowed to reinvest their dividends. We really encourage investors to think about this as about a 5-year investment. And in that 5 years, our goal and our projection is that we're able to double your money as the share price increases. So this graph really demonstrates where we believe we're going to be going as a projection. And I want you to take away 2 things here. The first is primarily the return is going to be captured through share price appreciation in the first few years. And that's really demonstrated in this dark green here. as we bring on more houses, as we do our renovation on those houses, as we push the rates to that market rate, which we just heard we're around 16% below market rates today, we expect the share price to be increasing. As we get to scale and as the REIT starts to have more houses towards that 10,000 house goal, we start to see that the share price will become less of a factor and it's more of a dividend yield that's driving total return. Okay, so Jim, I know one of the questions you were probably going to ask us, because that's coming up a lot, is what's the difference between the Peak Housing REIT, which is private, and a publicly traded REIT like Invitation Homes? And I think of like really Invitation Homes and American Homes for Rent, the options that you have as a public investor, that's a bet on the tailwinds that I just articulated. That is really a bet on the market itself. It's a great investment because you're getting exposure to single family rental markets. The key difference is that secret sauce, essentially, that we're adding on top with our privately traded Peak Housing REIT. And what that means is we have a value add tilt to our investment, which is going to allow us to increase value of the assets we buy, plus increase the rents. So we're already demonstrating success here in two very objective measurements. The first is, if you look at the cap rate of our average acquisition, and I don't know if white coat investors are familiar with cap rates, but I'm happy to walk through that if a question emerges. But the higher the cap rate, the higher the yield that you're obtaining. And an investor joining the Peak Housing REIT today has seen that we're acquiring houses at around a 6% cap rate. That compares to a cap rate which is much lower within Invitation Homes today. That delta, or that arbitrage, means higher cash yield for investors today, and also means that there's a potential that when we sell the Peak Housing REIT, if we sell a portfolio out of it in the future, that you can capture that arbitrage, that value creation. And then today, our dividend yield is 2%. We expect it to grow in the next year. That's our projection. And today, the REIT that you have at Invitation Homes and American Homes for Rent is less. So I mentioned the two ways to invest. And the first is the cash investment. We've already seen a lot of white coat investors join us here. And then the second is with the UPREIT investment, which is what Ryan was talking about a little bit earlier. And the thing I really want to add on to this is if you are an investor who owns a single family rental house today or a portfolio of houses, you have optionality to sell those houses to our REIT in a tax-free exchange. And so please contact us if that's something that you might be interested in learning more about.
And you'll take those in any state, Joe?
We will only take those in the states that we're currently operating in, which right now would be Texas, Indianapolis, soon to be Georgia, and soon to be Alabama and Missouri. So those are the markets we're currently in, and investors should feel free to reach out to us on that. So capturing kind of like the key other difference between a publicly traded REIT and a private REIT is the concept of liquidity. And so there's typically what's referred to as the liquidity premium, which is the more liquid an investment, typically the higher price you're paying for it. And that's definitely the economics that are in place today. If you choose Invitation Homes or American Homes for Rent, you have the ability to buy and sell your shares on a daily basis. Heck, you can trade that stock. Versus with the Peak Housing REIT, your money is locked for a 2-year period, which is that private REIT concept. A lot of the investors ask, well, how will I sell my shares in the future? And it's a pretty simple process. You request redemption from the Peak Housing REIT. We meet those redemptions, and we have the ability to meet those redemptions today through various methods. And this slide really kind of captures those. And these three in this green box today, this is something we've already shown that we have the capability of doing. And finally, when I think about an investment, I really like to understand what the downside scenario is. What is the risk analysis? And I think this slide captures a lot of complexity that we use to manage and run our REIT in one simple to understand concept. This top line here, this bright green line, This refers to historic occupancy of single-family rental homes. And you can see even data clear back to the Great Recession, single-family rental occupancy never really dropped below 90%. We run our portfolio, the Peak Housing REIT, at a break-even occupancy of around 75%. That delta between that occupancy level and this 75%, that's what we call our financial cushion. And we have levers we can pull along the way if things start to get worse than 90%. But protection of capital is always our number one goal. Then finally, I think, Jim, the most common question I refer to is how efficient is investing in the REIT, especially for somebody who has a high income and is paying high taxes. Well, first, we try to make this simple. So you receive a 1099 dividend statement. And as part of that 1099 dividend statement, you're going to see a lot of your income, a lot of your dividend income, be placed in what's called box 3. And box 3 is typically characterized as return of capital. And we have some work that we do underneath the REIT itself in the REIT's owned operating partnership, where we can use accelerated depreciation and other expense tools to lower the essentially the taxable income coming up into the REIT. So effectively what we're able to do is we are using those same benefits that somebody who owns direct real estate in the application within our REIT that ensures that we can minimize taxes as best we can for our REIT investors. We also believe in a lot of communication with our investors. So on a monthly basis, you receive very clear information about the growth of the portfolio, about what's going well, what's not, and also some industry data talking about strategy. On a quarterly basis, we provide consolidated balance sheet and profit and loss. On a yearly basis, we have a full third-party audit of the REIT, which gets posted to all investors, and you receive your 1099 dividend statement at the end of the year, typically in the first couple of weeks of January. And so that really kind of concludes the short presentation we had about this. And I really encourage investors to learn more about us and to reach out and ask questions. And one thing I really want to point out is Elisa, we have a head of investor relations, and she is happy to take phone calls and talk through things. And Ryan and I are as well. So thank you.
Mhm.
Awesome. Thanks for your presentations. I know everyone will find them helpful and hopefully answered a lot of the questions people have. We've had a couple of questions come in so far. Let's hit those first because they're kind of fun questions. And then I've got a few that I've gotten from other people beforehand. And of course, anybody who also wants to ask a question, feel free to just type that in as a comment underneath the Facebook Live and we'll get them answered here, as many as we can in the time we have. One person wants to call you out, Joe, on your car leasing percentage. They're like, nearly everybody leases their cars. And so I actually looked it up while you were presenting, and car leases went up dramatically from 2009 to 2017, from about $1 million a year to about $4.5 million a year. So certainly increasing. Although the statistics I saw show it's still between 26 and 33% of new cars are leased, not bought. So I think they're calling you out on that one, unless you have better data than I have on that.
No, and I think that's very fair. And thank you for keeping us honest on that part.
But a more relevant question is the REIT going after the Zillow homes that they're giving up? I think you probably saw that in the news recently.
Yeah. What
are your thoughts on that, and what any opportunities there for the REIT?
Sure. Well, that's a very astute investor to realize that is certainly an opportunity. So if you think about what Zillow has done, they've just gone and acquired and aggravated a huge portfolio. I think it's something like 18,000 homes they control right now. And there are institutions going after those homes today. So I think the first 2,000 of those homes was announced being purchased by a group called Predum last week. We do have the data tape of Zillow. We are reviewing those houses today, but we also know that those houses are selling for much higher than I think Zillow was projecting. So it'll be really interesting to see what the net result is of that aggregated portfolio. And to answer the question, yeah, we are looking at those houses right now.
All right. Let's I think there's about 3 places to defend your place on a spectrum here. Let's start with the spectrum of formatting of real estate. On one end of the spectrum, we have people that are buying the house down the street. They are managing it themselves. They're doing the upgrades themselves. They bring a tenant in, put them in. They collect the rent check every month. They go fix the toilet at 3 a.m. They're direct investors. On the other end of the spectrum is somebody that goes by and buys the Vanguard REIT index fund. Very, very passive, very, very diversified, very, very liquid. And you defended yourself quite well from the public REIT side. Defend yourself from the other side, from the side of people that want to put a little more effort into it, that want to have their own rental homes maybe, or maybe they're interested in buying syndications, that they get to select the homes themselves, or even a public or a private fund versus a REIT. What kind of investor should choose your investment over that style, that structure of an investment?
Well,
Sure.
I'm going to take this one, Joe, first, and then you can pop in. So along our way, as we were building the platform, we did turnkey rentals as we grew this out. And so we were a little bit further off that do it all yourself, Jim. And what we found is even in that, where we would handle the acquisition and the rehab and the management, if you're on title, it's a business. So whether you're on title for 1 home or 1,000 homes, it is a business. And this whole concept of passive, it's only passive if you're investing into something where you're not on title and truly just getting that passive income. And so what we had found is, for those that are doing their job, if you're a doctor, that's your job. And that's different than going out and starting a business of going out and acquiring homes and fixing those up and collecting that rent. And so certainly there are professionals and doctors and everybody else that want to go do that on their own, and that's fine. And maybe they'll do that for a period of time. But what we find is anybody that owns rentals for a period of time is going to get tired of having to make those decisions, whether it's third party managed or not. And I think then the other flip side to that is do you want to, if you've never done it before, do you want to get in and have to learn everything that it takes to do that whole scale from how do I acquire a property, rehab a property, manage a property, tenant lawsuits are the #1 lawsuit in the country. Do you really want to have to learn all of fair housing to get into that space and do it well? And that's a lot. And so, or do you want to invest into somebody that has, 2 decades worth of experience that understands all of these and has built a whole platform around it? We think we compete at the top of the scale when it comes to passive income investing into real estate. But that doesn't mean for some people, the right thing to do is to go do it on their own. And that's not who we're going for.
Okay. And I think I would add really quickly to that. If you think also, when a single investor owns maybe a small portfolio of homes, what is their primary objective? I mean, we can all probably guess it. It is maintaining the home's occupancy. That means they really want to make sure a renter is in there, regardless if that renter is way under market. Within a REIT, we still want that occupancy, but we have the ability to control our occupancy levels by increasing rent. So it allows us to capture a higher rent than most small landlords. And then also kind of in this spectrum, you really captured somebody that wants to do it yourself and the big diversified REITs. Our private REIT, the Peak Housing REIT, these 3 strategies also includes the build for rent component. And these build for rent joint ventures that the REIT has, that essentially means every single new home that the REIT is building, 100% of that income and equity is coming into the REIT itself. And it is really hard for investors to go find opportunities to invest in build for rent communities right now. We had one go out on Crowd Street. So the Peak Group, we did a build for rent and went out on Crowd Street. We raised $6 million in something like 45 seconds. And it's nearly impossible for investors to get in on those through CrowdStreet. Investors in the Peak Housing REIT get access to that first and foremost. So that's a huge benefit and something that you can't get on both of those spectrums as well.
All right, so now I'm going to ask you to defend your space in the asset classes among real estate. Single-family homes, multifamily, retail, industrial. Investors have a choice. Why should they put some of their money into single-family homes versus those other asset classes right now?
So I'm gonna capture it on the inflationary side of things, and maybe Ryan can add some more. So I think I captured a little bit of this during the presentation. But first and foremost, when you think about the asset class, it's the length of the lease that is there. So even stepping higher than that, like housing period is typically the most important aspect of what people are going to pay for. Roof over the head, food in the belly. So right there's a certain level of need that comes into housing period. But secondly, it is that inflationary protection that we can reset leases on a yearly basis. And with a lot of what I call traditional commercial assets, like office and retail and industrial, there are long-term leases associated with it. And then finally, this is a very stable asset class, providing very stable asset type returns. And unlike office, which tends to be very cyclical, and warehouse, which tends to be very cyclical, you can really count on a very consistent return coming out of rental housing like that. Ryan, would you add anything else to that?
I think the only thing else I would add is, they all have value in all of those different asset classifications, Jim, but I don't think any of them have the upside, alpha that we can create because it's still so new in this game of being brand new. It's the newest institutional asset class there is. And, institutions control 3%, like Joe said. So there's so much upside in aggregating this market and so much value to be captured at that I think it puts it at the top for that reason as well.
All right. For those who are just joining us and missed the introduction, I'm talking with Ryan Bowers, the CEO of the Peak Group, as well as Joe Ollis, the Chief Investment Officer of the Peak Group. We're talking about single-family home investing, as well as the Peak REIT, which invests in single-family homes that they run. And so you've talked a little bit about your place on the spectrum in the structure of the investment. We've talked about the asset class itself. Now you have chosen to aim these homes at workforce housing rather than, middle class, rather than luxury homes. Defend that decision. Why do you think that's the way to play this rather than going for, larger, nicer homes, for instance?
Well, I'll start there. I think on one hand, by and large, it is middle class. And I think sometimes workforce housing can kind of get strewed into this, like, is it tax programs? Is it Section 8? No. If you look at our new build for rents, these are beautiful homes. If you look at how we rehab, these are beautiful homes. And we provide a really nice place for people to call home. And I think the reason why we go after this so hard is because most people look at real estate and they say, hey, either cash is king or appreciation is king. And we say stability is king. And so to grow a stable asset over time and to make sure that we are protecting the principal capital of our investors and ourselves, we want stability. And so when you look at, workforce housing, which is affordable housing, we can stay in that 30%. Even in down markets, people need that kind of housing. In up markets, people need that kind of housing. If you go really high end, what I would consider the class A of single family, when we have a recession, whenever we have a recession, those are going to get hit the hardest. And a lot of those people, we're going to lose some residents that have to move out, but we're going to get a drop down from those above us. And so we just feel there's no more stable asset class within single family homes than what we're doing. Joe?
Yeah, I think the only thing I would add to that is really looking at where in our income spectrum we're working versus those publicly traded REITs. So that average income for an area, we're targeting that 30 to 35%. That's really like the max that we'd want to go to is 35%. Those publicly traded REITs, they're operating in an area that's higher than that. They're in that like 35 to 45% of the average gross income for an area. So I truly believe that what Ryan has articulated is the buffer, essentially. That is what we believe is going to maintain the stability of our REIT, of the dividend yield of our REIT, and also provides a lot of insulation if there is a softening in the housing market. These houses will be occupied. They're going to be occupied at rents that are affordable for the vast majority of people. And we believe that's going to maintain the values of these homes, but also then that dividend yield.
Okay, let's talk for a minute about investment minimums and fees. The investment minimum for the REIT is $25,000, which is relatively low among investments that require you to have accredited investor status like this one. Tell us about the fees. There's two types of fees, and tell us what they cover, what they are, etc.
Sure. That sounds good. I'll take this one. But before we get into that, so $25,000 is the minimum investment, but we're seeing a lot of reinvestment. And that by a lot, I mean over half of our investors in the first year have already increased their investment. So we lowered to a $25,000 minimum because we know a lot of people want to come in, appreciate and understand the asset class, get to know the Peak Group and the way we communicate with our investors. And we expect to see reinvestment in the future. And that could be as simple as a dividend reinvestment, or it could be people increasing their investment along the way. So the fees that are associated with our REIT are very simple. The first is we have an asset management fee, which is charged on the equity that's placed into the REIT. And we have an acquisition fee every time we buy one new house or a new portfolio of houses. Those fees are 1.35%. After an 8% preferred return that is paid yearly, there is an 80-20 split where the investor receives 80% and the sponsors of the REIT, that would be Peak Group, receive 20%. That's it. That's the simplicity of our structure for fees and promote.
And that's without a catch up on that 20%?
There is no catch up.
Yeah. To explain the acquisition fee, is that the value of the home? Is that the equity going into the home? What's that 1.35% of?
That is the acquisition value of the home. So that would, if it's a $100,000 home, it's a $1,350 acquisition fee.
Okay. All right. Now I'm starting to run out of questions, folks. So if you got questions for these guys, you better type them in, or we'll be ending this and you won't get a chance to ask your question. But we're still live here on Facebook. As you type your questions, I'm seeing them, and so feel free to ask any questions you have about this stuff. Now, one of the big advantages you have here, compared to a lot of other investments we've talked about in this group, aside from the $25,000 minimum, is the ease of tax preparation. You're not going to have to file a tax extension if you guys are sending out your 1099s in January. You're not going to have to file multifamily state returns because you're not getting a K-1. But at the same time, you can't use the depreciation from this investment to offset income from another investment. It basically only offsets the income from this investment in the form of turning your dividends into return of capital, essentially, from a tax perspective. Would that be fair to say?
Yeah, that is definitely the case here. And I think that what we found as we really pulled a lot of our investors is they appreciate this simplicity, and especially for gaining access to such a sophisticated investment thesis with the single family housing.
All right, I had a question come in. Oh, this one's for me from Victor. Jim, are you investing yourself? Yes, I've invested in the fund at the 25,000 level, and watching how that performs for now. So excited to see it. And the play for me here is that the vast majority of my private real estate investments are multifamily. This is the only one I really have that's single family homes, and so it's a diversification play. That provides me access to that portion of the market, which I'm convinced is also likely to grow. A lot of people out there just prefer renting homes. I mean, ask residents, right, what they want. Oh, I don't want to be in an apartment again. I want to be in a home. I want some space. I want a backyard for the dog, but at the same time, when you're in a 3-year residency, it doesn't really make a lot of sense to buy. So those are ideal people for this sort of an investment. You get a great long-term tenant in there. Your vacancy rate's low, and you basically have somebody that wants to stay in the same place. They're not quite as mobile as people staying in apartment complexes, for sure. All right. Any other questions? Feel free to type them in there. Otherwise, these guys have done a good job of answering at some point during the presentation or since most of the questions that I have received by email for them. Again, the UPREIT system is pretty unique as well. If you have property in any of the states that they are located in and don't want to be a single-family home investor, if you're an accidental landlord maybe, this is a chance to get rid of it tax-free, right? Essentially, it's a tax-free exchange, just like a 1031 exchange. You do one of these, what is it, a 572? Is that what the number is on it?
721.
721. 721 exchange, you basically exchange the value of your property for shares of the REIT, and you don't have to pay any taxes on the gains on the property. So it's a pretty cool way to diversify your investment, but mostly get out of being the manager and be able to have a more passive investment. All right, here's another question that's come in. Are there build for rent plans in the other states you listed?
There are, and so we're working on that right now. In fact, we were just in Georgia this last week, working on a multi-year deal with a developer builder there. We are also working out current structure in Springfield, Missouri, where we're at, and also in Indianapolis. So yes, build for rent in other markets are certainly a part of the growth strategy.
Okay. All right. I think we've covered all the details I wanted to get covered, unless we have other questions, and you better get them in fast because we're about to wrap this up. I'm going to let these guys get on with their evening. I think you're on the West Coast, Pacific time right now, right?
Go ahead, Joe.
I am. Ryan's in Texas right now, and
Okay,
I'm in Seattle currently. And so I can go all night with investments. But I'm pretty sure Ryan's ready to go get some dinner.
Yeah, I don't blame him. I think I'm about ready to go get some dinner. I think I've got to make it first, though. I'm on for dinner tonight. But it's been great to be with you guys. I appreciate all the effort you've taken to educate white coat investors about this asset class, about your investment in particular. And I know I've talked to a lot of people by email about it. There's a lot of interest in it. It's something we haven't presented here before, not only with a lower minimum than a lot of funds we've talked about, but with an asset class that there's not a lot of REITs out there investing in. And between the passivity of the investment and the tax efficiency of the investment, as well as the minimal tax hassle of the investment, which I know after having filed in 9 states this year, I know is on the mind of a lot of real estate investors. But we appreciate you guys coming on. It's an exciting investment, and hopefully it's one that can help a lot of white coat investors reach their goals.
My dad, your host, Dr. Dahle, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.